Dr. Gopinath, thank you so much for joining Bloomberg Surveillance. There is a search for a theory out there in central banking right now. Our central bankers, such as Mr. Powell, Mr. Draghi, Mr. Carney at the Bank of England, are they flying blind? Are they making it up as they go? Or is there actually a theory?
They're absolutely using a framework. They're following the data closely as it comes in. They're keeping their mandates in mind, and they're using the instruments that they have at their disposal. I mean, now that said, the amount of space that they have is far more limited than they had about 10 years ago. And that's something that they have to pay attention to. But they do have a framework.
You said it precisely, the amount of space. Let's get mathy, and maybe it's their limited degrees of freedom. What is the to-do list from you and your team for central bankers trying to assist their economies back to something approximating normal?
Given the economic outlook that we're seeing in many parts of the world, we welcome the accommodative stance of central bankers, and we expect them to continue to be data dependent and, even more importantly, to communicate very transparently their plans. So, you know, they certainly are responding appropriately at this moment. Of course, we are also flagging the importance of making sure that financial vulnerabilities are not building up. That is a concern, and there should be macroprudential tools should be used to make sure that such risks don't build up in the global economy.
Gita, Gopinath, I was going to ask you just that. Does the world economy really need more monetary stimulus, or are you worried about the secondary effects? So should we focus on something else, for example, dealing with the trade war?
I mean, it is absolutely essential to deal with the trade war. I mean, we've put that out there. We've said do no harm. Trade risks are our number one risks to the global economy. Now that's spilling over to technology tensions too. And so that's something we worry about. So de-escalating on the trade tensions front is hugely valuable, and it would do a great deal good for the global economy.
Right, but so do you think that the world economy also needs more stimulus, or could it do more wrong than good longer term?
The two go together. A lot depends upon what policymakers do. There's tremendous policy uncertainty at this point in time. In April, we had flagged that the world economy was at a global moment, and this is exactly the kind of scenario we're talking about right now. Monetary policy will have to play a role, but other policies will also have to come in, including fiscal policy, especially for countries that have fiscal space. I mean, that would also need to be an instrument that gets used.
Dr. Gopinath, Madame Lagarde in a recent speech said we need time to gauge the balance of risks. It's a very important idea, the continuum of time. What is the urgency right now for central bankers to act to stimulate the economy, or do they really have time to be data dependent? And to get to this afternoon's meeting, does the American central bank have time to wait?
I mean, the U.S. economy is doing quite well. I mean, unemployment is at 50-year record lows. And so there is a good argument to be made to continue to be data dependent and to see how the risks play out. I think at this point what we are seeing is central banks signaling a willingness to step in maybe sooner than we thought. But of course, when actions actually take place, I mean, that's going to be dependent on the actual numbers that come in.
I mentioned, Dr. Gopinath, in my introduction, the wonderful work of Rudy Dornbush and Ken Rogoff at the IMF and in their academic careers as well. That comes down to our first mercantilist, Mr. Trump, in his tweet yesterday on Eurodollar, on Draghi, and on dollar dynamics. Do you see manipulation out there? I mean, Ken Rogoff wrote a paper about the wonderful value of free and floating currencies. Is the president overdoing the threat of currency manipulation?
A very natural side effect of using monetary policy is that it affects your exchange rates. And so that's just how it works. Now, of course, at a time when interest rates are already pretty down to zero, the effect starts showing up on exchange rates much more. But that said, I mean, another finding that we do have is that small movements in exchange rates of the magnitude of 1% is going to do very little for the competitiveness of a country. And so, we'd be having to talk about much bigger movements before we need to worry about loss of competitiveness or gains.
An open question, Dr. Gopinath, on from the World Economic Outlook and the rest of your good work, the Green Book on financial stability. How does the IMF gauge the left tail right now of the global financial system?
So we are in a world with very high levels of debt, and this is true both in the private sector and the public sector. Of course, it's unevenly distributed. In some countries are more susceptible to it than to others. So on the plus side, we are certainly living in times where financial conditions are comfortable in the sense that interest rates are still very low. Central banks seem to be very accommodative. So that helps. But at the same time, risks are always there. And with parts of the yield curve reversing, those things usually signal concern for the outlook going forward. And it's therefore very important to use macroprudential tools to make sure that these financial risks don't keep building up.